And today I am going to be talking about how to cut your tax bill. For the people on the chat, if you guys could just let me know that the audio and visual is coming through okay, that would be great. Perfect. Thank you, team. Today we're talking about how to cut your tax bill. Look, in Australia, we pay a lot of tax, and obviously every dollar of tax that you save is money that you can direct to your savings, your investments, or even just your next holiday once GoMo lets us travel again. So today I'm going to talk about some of the key things for you to be thinking about and aware of so that you can get better results from your tax planning, keep more of those hard-earned dollars, and ultimately get ahead faster. So guys, please don't rush out and make any life-changing decisions off the back of the presentation today. Would strongly encourage you to seek out personalized advice before rushing in. Some of these tax planning stuff, it's big decisions that could impact you for years to come. So makes sense to do that anyway. And look, guys, as we're running through the content today, I'll talk about these problems in a sec, but as we're running through the content today, if you've got any questions, feel free to just pop them into the Q&A box if you can, and I'll sort of tackle those as we go through as well. So guys, look, everyone's situation is unique, but I found that there are some pretty common challenges when it comes to tax and also when it comes to tax planning. It's information overload. We're drinking from the fire hose, so much information out there, too many options, and you don't know who to listen to or who to trust. People struggle to find balance between making smart money moves to get ahead and being able to at the same time live the lifestyle that they want. And then we have a fear of missing out. The psychology that sits around our money is significant, and also the fear of making a mistake or the fear of effing it up and doing something that can end up costing you a bunch of money down the track. So that leads people to get stuck, and it's stuck, not always stuck doing nothing, but stuck doing the same things that you've been doing in the past and missing opportunities to be getting ahead faster. So today we're talking specifically about tax, but there are these three elements that you need to get right, which is structure around making it easy to save and manage your money, having clear goals and targets, knowing how much money you've got to work with. And this is where the tax planning comes in, how much money you got to work with when it comes to savings, investments, prime property, these sorts of things. Your strategy, understanding the pathways in front of you, getting clear on what that is so that you can have confidence to move it forward, and knowing what your action plan is, and then your solution, so the investments to actually back up your plan. So if you get all of those three areas right, the power of all of them combined is much more than any individual element. And if one of them is missing, it ends up dragging down on the others. If you're not good at saving, then it's going to be hard for you to know and make some smart moves. Without a strategy, you're missing out on opportunities to get more out of what you've got and leaving confidence on the table. And bad investments, you end up blowing up your cash. So today we're diving deep into tax, but I just wanted to frame that up to say that there are, there's broader things that you need to be thinking about to make sure that you're getting the right money outcomes, and we'll direct you to some resources on that at the back end of today as well. So guys, look, a bit of an overview on the tax system, and then I'm going to get into some tax tips and strategies off the back of that. The first thing that you should be aware of is that in Australia, we work on a marginal tax rate system for individuals. And what that means is that incrementally, as your income increases, you pay an increasingly higher proportion of the higher income in tax. So that's a lot of words, but essentially what it means, and what I've got up here, is to say if you're on the first $18,200 of income that you earn, we pay 0% tax in Australia. Now that applies if your income is $10,000, if it's $20,000, if it's $200,000, if you make $2 million a year, doesn't matter. You still pay 0% tax on the first $18,200 that you earn. Once you start earning above $18,200, and up to that $45,000 mark, you pay 19 cents in every dollar, or 19% of your the income in that bracket ends up getting paid out as tax. Now, one of the things that a lot of people find confusing is to say that if people think that when you go into a higher tax bracket, that you immediately start paying that higher proportionate rate or the higher percentage rate on your entire income. That's not the case. You only pay that percentage on the income that relates to that bracket. And so then you see like the next bracket up is 34.5%, which runs from 45 to 120,000. Then you got 120,000, 180, you're paying 39%. This all includes Medicare levy as well. And then 180,000 plus, you're paying 47%. Now, if you make $300,000 a year, you still pay, and I know I'm laboring this point, but it is something that confuses a lot of people, but you still pay no tax on the first 18,000. Then you pay 19% on the amount in this bracket, 34% between 45,000 and 120,000, 120,000, 180, you pay 39%, and then 180,000 plus, you're paying 47%. So a lot of people, yeah, as I say, they think that when you get like a pay rise or a bonus and it pushes you into a higher marginal tax bracket that you pay on the whole amount. That's just not the case. So yeah, just beware that there's no point where you earn more money and end up with less money in your pocket. There are some nuances around like HEX repayment rates and that sort of stuff, which I won't get into in too much detail. But from a pure tax perspective, then that's essentially how it works. Now, in Australia, there are different sort of entities that you can use to manage your tax. Your personal marginal tax rate, like you just have one tax rate. So that your one tax rate applies for your employment income, interest income from your high interest savings account, rental income from property, if you've got an investment property, capital gains income, that all gets added to your personal marginal tax rate and taxed appropriately. So the ATO doesn't care if you got $90,000 in employment income and $10,000 in interest income. The ATO just taxes you as if you earn $100,000, and it's exactly the same amount of tax that someone that earns an income of $100,000 would pay. Again, seems straightforward, but it's something that a lot of people do find confusing. So personal, you get the marginal tax rate. Now, super is an interesting one. And clearly with super, you need to balance the fact that once you put money into super, that it is tied up for like a whole bunch of time. So, you know, it's not like you put money in and take it out whenever you want. But the super tax rates is the maximum rate is 15%, and the 10% rate applies to capital gains on investments inside your super. So investments like shares, where if you've held the asset for longer than 12 months, then you have the ability to get access that CGT discount, and you only get taxed at 10%. Now, if you think about super compared to your personal tax rates, you can see that if you're looking to build a significant investment portfolio over time, you're going to pay a considerable amount more tax by having the investments and the investment income in your personal name taxed at your marginal rate versus something like superannuation or some of the other structures, which I'll cover in a sec. So you got superannuation there. The next one is a PTY Ltd company, so proprietary limited. And anyone can set up almost anyone, if you're not in trouble with ASIC, can set up a PTY Ltd company, and you can open a bank account in that company, you can open an investment account in that company, and you can invest through that company. Now, the tax rate for a company whose sole purpose is investments is 30%. Now, again, that's when you go back to our marginal tax rates, you can see that if you're looking to build a considerable amount of income in the future, then having a 30% tax rate as opposed to a 47% tax rate is something that can save you tens of thousands of dollars each year, which is certainly something worth thinking about in the right circumstances. And I'll talk about some of the nuances that sit around that today as well. And then a trust. So what I'm talking about with trust here is family trust or discretionary trust. There's a whole bunch of different types of trust, but the most common one is a family trust, which is actually just a discretionary trust that you choose to nominate family members to be the beneficiaries of. So I'll talk a little bit more about that, but essentially with a trust is sort of like the proprietary limited company that I mentioned, where if you start a trust and get your accountant or lawyer or whoever to do that for you, you can again open an investment account in there, a bank account or whatever, and you can invest inside a trust. And then the key rule with the trust is that a trust is required to distribute the assessable income that it pays each year to another tax-paying entity. That's like the key rule of a trust, is that it has to distribute to another tax-paying entity, or pay tax at the top marginal tax rate, which really sort of defeats the purpose of having a trust in the first place. So what that means is, and I fully appreciate that there's a bit of complexity that sits around this, and please don't rush out and make any, jump in and do this without doing your research. But with a trust, if you've got, say you've got $100,000 of investment income, you can choose to distribute it to yourself, to your partner, to your black sheep cousin that doesn't really have a job or much other taxable income to speak of, or like potentially a proprietary limited company, which again has that 30% tax rate cap on it. So trust can be a great way depending on the situation. And I've got a couple of slides on that to run through, but can be a good way to give you a lot of flexibility, but also to save you a significant amount of tax over time. So I touched on this already, but you only get one tax rate. So for when you own investments or earn income in your personal name, it doesn't matter if you're earning employment income, interest income, rental income, dividend income from shares, all of that stuff just gets added to the one tax rate, and then you pay tax accordingly. There are different tax rates for different entities, which I ran through. And look, for individuals, for PAYG individuals, which means employee individuals, so not self-employed people, but people that are employees of another company, which is, the majority of Australians, there's a limit to how much you can deduct to save tax. And I've got some pointers on that, some things that you should be aware of to maximize those deductions. But by far and away, and in significant multiples of the amount of tax that you can potentially save from getting deductions, the biggest way that you can be tax smart is by being smart with your investments. Choosing the right investments and structuring your investment portfolio in the right way is something that's going to deliver you a considerable amount of tax benefits now and into the future. So I'll talk a little bit about that. I'm going to talk about investment tax in a sec. But just before I do, I can see that there's a couple of questions here. Lisa asks, if you don't have physical assets, does discretionary trust still make sense for family? I'm not exactly sure what you mean by physical assets there, Lisa. If you mean property, then if you're talking about like if you don't have physical assets like property, then you might have assets like shares, and that can still make a lot of sense. Maybe you could just clarify that one for me, but I don't know physical. If you don't have gold bars, but you do have I suppose property is physical. Property, yes. Yeah, if you don't have property, thanks for clarifying, Lisa. If you don't have property, it can still make a ton of sense, because if you think about you got a significant share portfolio, you can choose to own it all in your personal name, and then you have no control over the capital gains outcomes, where the dividends get streamed to, that sort of stuff. Whereas if you have a couple, you can distribute split the income. You got $100,000 income, you can split it equally across the two people. If you have kids, when your kids grow up, once they get over 18, you can distribute to them, and you end up paying a considerable amount less tax over time. So good question, Lisa. Rebecca says, any advice for an American citizen living permanently in Australia with an American-based LLC employed by American company? Should I continue my investing portfolio in the US or Australia, or should I have both US and Australian portfolios? That's a good question, Rebecca, and something that we see a lot, because we do live in a global world these days with a global workforce. And look, there's no one right answer to that. And look, I'm not an expert on American tax, although we do have a lot of US tax citizens, where interestingly, the US and Libya are the only two countries in the world that tax their citizens on their global income, regardless of where they're a tax resident. The majority of foreign countries, you have one country of tax residency, and then you do the majority of your tax in that area. Not the case in the US. So yeah, I would say that if you're thinking about basing yourself in Australia indefinitely, then it's more of an argument towards having a portfolio and the majority of your investments in Australia. I know in America that there are some state-based taxes as well that you can't avoid, doesn't matter where you're a resident. So that can be an argument in favor of. But in the, given that it sounds like there's a bunch of stuff going on, I'd probably suggest you get some expert support on that so that you can make sure that you're making the best decision for you. Another question here is, what is the reasoning behind companies being taxed less than individuals? I don't know. That's just how the system works. It's a good question. Not sure the logic. You have to ask ScoMo on that one, or maybe Mr. Frydenberg. Would you be covering general DTA for dual tax residents? Divya, I'm not sure if you mean double taxation agreements, then it's probably beyond the scope of what's here. But generally speaking, there are dual taxation arrangements for people. There's not many dual tax residents. As I say, that it's only the US and Libya where you can actually be a dual tax resident, where every other, it's not that you've got one main tax residency place, but the US make you be a tax resident of the US. So I would suggest getting some specialized advice on that one, Divya. All right, so I'm going to talk about investment tax, and I want to show you why this is important. I've got a quick example here with a few numbers to put some things in context and how this scenario, I suppose the inputs to this scenario are basically starting investing with $0 today. So starting with no savings or investments to speak of as yet, and you save $1,000 a month, and then you invest that into the share market. Now, I've used the 20-year average Australian return on the Australian share market of 8.7%. And if you were to start with $0 today, start saving $1,000 a month today, and then reinvest that money and let reinvest the dividends, reinvest the growth over time, that after about 10 years, and certainly if you did this in the last 10 years, that you would have about $190,000 now. We know that the past doesn't predict the future, and I was never here, this never happened, but this is what these are the actual numbers, what it would have been if you did this 10 years ago. And in my view, that it's probably a pretty good benchmark for what we should expect in the future. In fact, I don't think there's anything that suggests that it's going to be significantly different moving forward. So 10 years, you put in 120 grand, that's your $1,000 a month. So $12,000 a year, $120,000 over 10 years, you'd have 190 grand. 20 years, you would have put in an extra, in the next 10 years, you put in another 120 grand, but you can see that you're getting some good growth here now on the investments, $640,000, almost tripled. If you started 30 years ago, you would have put in 360,000, but have 1.7 million today. And 40 years ago, $480,000 in total in terms of the amount that you put in. But you got $4.2 million. It's like almost a 10x type return, which is pretty significant. So I get that there are a lot of numbers there, but what I'm trying to show you is the power of time when it comes to your investments. And this is why tax planning is so important in the early days, because if you're starting a portfolio today and you follow this strategy, and say you follow it for 30 years or 40 years, and you end up with this multi-million-dollar portfolio over time, you can see that the tax implications of getting your structuring of this right and your strategy around the tax side of things right. We're talking about seven-figure numbers here, and the tax implications are in the six figures easily off the back of that. So that's why you want to get it right from the start, because it's really difficult to change things when you get too far down the track. I'll talk about the tax on different types of investments here, and what I've got is share investments. So share investments is like shares on the stock exchange where you buy a share in a company. It's also exchange traded funds, or ETFs, pretty popular at the moment, and managed funds, which is a fund comprised of shares. Now, with share investments, it's probably worth separating them into Australian shares and international shares, because the tax is slightly different when it comes to the income that you receive on those shares. So with Australian shares, and I mentioned company tax rates, and we all see that, when the big banks report their multi-billion-dollar profits, the banks pay tax on that profit, and then they pay a dividend to their shareholders after the tax has been paid. Now, because that company has already paid tax on the profit, so say they earns $5 billion in profit, pays $1 billion in tax, then there's a tax credit for the tax that's paid by that organization, that when the dividend is paid out to shareholders, that tax credit actually goes into your tax return and is a credit against the other tax that you would have paid. So Australian shares in particular can be quite tax effective in that way. The company tax rate for it's 30% for a purely investment company, but it's lower than that if it's an active company that's got an operating business inside it, closer to sort of 27%. And what that means is that I might just flick sort of way back over to the marginal tax rates that we see, that if you're building up, say, $100,000 of investment income in the future, and it's already had the tax paid on it at 30%, you can see you're going to pay hardly any additional tax, if any tax at all, and therefore it's a very tax effective portfolio and income stream for you in the future. So understanding the tax on shares and the tax on the income that you get from shares, the dividend income, is something that has a big difference in the after-tax return. And I think I'll run through these investments, but with any investment, what you should be thinking about is the after-tax return that you get from your investment portfolio. Not so much what's the headline return, because that's really, that's all for show, but what you end up with is the return that you get after tax. So that's really where you should be focusing. So we got share investments there. International shares, they don't have, doesn't matter if the company's paid tax overseas, they don't give you the tax credit on dividends there. That's called franked dividends or franking credits, which you may have heard of, but that doesn't apply on international shares. So again, there's a difference between Aussie and international if you're looking to build an income stream from investing. Property investments in Australia, when you buy a property, the government, or the ATO rather, when you do your tax return, they add up all of the income that you receive on an investment property, and then all of the interest expenses and any other expenses that relate to that property. And the net income from that property is what's included in your tax return. So if, for example, you've got an investment property and the rental income is $30,000 a year, and the mortgage payments are $40,000 a year, and mortgage payments and other costs, just to make my example easy, then the net cash flow of that property is negative $10,000 a year. That $10,000 gets added onto your taxable income. Because it's a minus, it reduces your taxable income, and then you get tax back on the amount because you've already paid up tax on the other sources of income there as well. So property, that's negative gearing. That property is something that can reduce your tax when you do it the right way. With newer properties as well, that when you buy a brand new apartment, an apartment is an easy example, because when you buy an apartment, you're really just buying what's inside the four walls as opposed to buying the building on the outside. But you buy an apartment today, it's got a brand new oven, it's got a brand new bench top, it's got a nice a washing machine or something in there, I don't know, maybe. As soon as you use that oven, you cook a roast chicken, the oven's worth less. It could be $4,000 when you move in. You cook that roast chicken, maybe $3,500. I don't know. Or if you tried to sell it to somebody, you're not going to get as much money back. And the deterioration in the value is called depreciation. Now, that doesn't actually cost you money. It's not like you have to pay money because the value of your oven has gone down, but you can claim that reduction in the value of the fittings in your property as a tax deduction, which means it's a non-cash expense that you don't need to pay for, which you can claim a deduction for and get cash back on. So that's why depreciation on new properties can be a compelling sort of benefit of that property. Now, you never want to invest for tax purposes alone. So there's a lot of property spruikers out there that talk about cash flow positive properties from day one, and it's all based around these tax benefits that they're as I see them, they're the cream on top, because the tax rules can change, and if that happens, you could be the one left holding the bag. So if you're going to invest, don't invest without knowing that your investment is a smart investment, excluding the tax benefits. The next one is super there, and people don't realize, but super is one of your biggest assets, and the tax rates that are inside it are very favorable, as I discussed before. So you understand the rules and use them to your advantage. Also, you think about if you think about your overall wealth portfolio between share investments, your cash savings, any property investments, and your super, have a considered tax strategy that leverages the different tax rates and tax rules between those entities that makes sense for the investments that you've got. So, for example, if you're investing in super where the capital gains tax is much lower, you might invest in investments that are more focused on capital gains. Whereas in your personal name, you might have investments that are more weighted to Australian shares where you've got franked dividends. And then that way you've got a more tax efficient portfolio in your personal name where you can't manage the tax as well. Whereas in super, you've got those benefits there. So it makes sense to consider the portfolio altogether. And then you've got trust investments, which I've spent a bit of time talking about as well. So jumping into Australian shares, I touched on a lot of this stuff as well, but the assumption around this is you get a bit of income and a bit of growth, the franked dividends on Australian shares. Exchange traded funds are something that have sort of taken the Australian investor market by storm, mainly driven by potentially the FIRE movement or a lot of these online forums, and also more interesting and quality investments and assets that are happening in this space. It's worth looking at. And with an exchange traded fund, you end up with a little bit more control over the tax outcomes because you own a tiny sliver of each of the shares that are it's basically a parcel of shares. With an exchange traded fund, you own a little sliver of each of the shares, and then if you don't sell them, then there's no capital gains tax. Whereas when you're in a managed fund, then you have less control over the tax outcomes. It gets a bit technical, but I do actually have some resources which I'll share off the back of today that had an interesting video that steps through that process as well. And with your Australian shares, one of the key questions that you need to ask is, where do you actually hold that investment? Do you hold it in your personal name, trust company, or your super fund? As I was talking about before, that's a key question to answer. Property, I mentioned some of the tax implications before, but by far and away, the biggest benefit that you get from buying property as an investment or your own home is that you get you use a deposit or a smaller amount of money to buy a bigger asset, and then you have that bigger asset working for you. So the gearing benefit is compelling because if you've got $100,000 that you could put into a share portfolio, you're going to have $100,000 worth of shares. But if you use that $100,000 as a deposit, you could end up with a $500,000 property or more, and then you've got this much bigger asset that's working for you. So gearing benefit is compelling. That's not a tax thing, but it is something that is worth thinking about alongside some of the other tax implications and benefits that are there as well. Understanding investment versus own home. I mentioned getting tax deductions for interest expenses on an investment property. You don't get the same tax deductions for paying your home mortgage. Unfortunately, that would be nice, but there's no tax credits or benefits for paying interest on your home mortgage. So getting it right between having an investment property versus having your own home is something that can save considerable tax over time. Negative gearing, I talked about. Tax, the deductions on property can be good. You get more things that you can deduct in maintenance, repairs, improvements, that sort of stuff. And then with property, and I'll talk a little bit more about this, but the ability for people that have their own home, owner-occupied properties, to undertake strategies like debt recycling, where you can turn non-tax deductible home debt into deductible debt and get yourself a bunch of tax deductions along the way. Super tax, I mentioned that income tax at 15%, capital gains at maximum 15%, potentially 10%, but then you've got to balance it against the fact that your money is essentially trapped in super until you're getting close to that retirement age. So you want to balance that out. Trusts, again, I touched on this before, but streaming, you have the ability with a trust to, when I say stream, it just means distribute income from your investment portfolio to multiple tax-paying entities, including individuals and potentially investment companies. But with tax, there are costs to set a trust up, probably looking at a couple of grand or so to do it the right way properly from the start, get someone to help you. But also each year you need to do a tax return for a trust. It's its own tax entity, like you're a tax entity. Like you need to do your own personal tax return. With a trust, you need to do a tax return for that entity as well. So there's some tax compliance and tax return costs in there. When you buy property in a trust, there's no land tax exemption. So you start paying land tax from $1 of the land you own, which can be in New South Wales, it's like 1.6% of the property value. So if you've got $500,000 worth of land, you're going to be paying about $8,000 in land tax each year. Worth being aware of, not a small amount of money, but you also need to then balance that against the potential capital gains in the future, whereby you know that could be in the tens of thousands or hundreds of thousands of dollars, depending on what the situation ends up being. Investment company I touched on. And then, sorry, just a tip for people that are trusted, it generally starts to make sense when you've got at least 6 figures to invest, so in the $100,000 or more, at the very least, and you want to have strong regular savings coming in for the juice to be worth the squeeze. For a lot of people, if you're aspirational and looking to build significant wealth over time, it's probably something, a trust is probably something that you will introduce at some point. But it's the right move at the wrong time is the wrong move. So make sure that you're doing it when the timing is right, and the benefits that you get are going to outweigh the costs. I'm going to go on to tax strategies in a sec, but I can see a bunch of questions here. Got a question that says, hey, in ATO website, my current job says not claiming tax-free threshold. Will I lose money in taxes? I am trying to get them to update it. Yeah, thanks. Look, what that means is when you fill in those forms, when you join a new employer, it says, do you want to claim the tax-free threshold or not? You put yes or no. If you put yes, then it claims the tax-free threshold as per normal. If you put no, then it doesn't claim the tax-free threshold and starts taxing you as if the first dollar that you earned is $18,201, which is just the first dollar past the tax-free threshold number. So that means your employer is going to withhold more tax in their PAYG, BAS installment stuff. But when you will get that tax as a credit when you do your tax return. So if you earn, say you earn $100,000, if you claim the tax-free threshold, you might get taxed 30 grand in that year. I'm just making these numbers up, by the way. But if you don't claim the tax-free threshold, it might be 35,000. When you do your tax return, that'll all work out in the wash. But at the end of the day, the money's probably better in your bank account than the ATO's. So yeah, you don't need to. Unless you want the ATO to have like a forced saving strategy for you, then you probably better to claim it if it is your only job. Another question, do we need to include interest income from savings accounts in our tax return? Yes, you absolutely do. That actually most of that data sort of feeds straight into the ATO portal these days anyway, because the ATO is significantly increasing their reporting obligations for financial services providers. So yeah, interest income, dividend income, trust income, company income, sole trader income, and employment income all go together to add up to your total personal assessable income. Varun says investment bonds or investment loans, share investing for tax deductions. Yeah, look, investment bonds can, in some cases, make sense. The reason that with an investment bond, it's sort of like having an investment company, that they're generally taxed at a maximum rate of 30%, and then they give you no capital gains tax if you hold them for like an extended period of time and keep checking in, keep contributing in line with the rules of the plan. So they can be good. Investment loans for shares can also be a good strategy. I think I've got that in here to talk about as well. But I'm personally not a huge fan of margin loans, because the interest rate on those borrowings can be quite high. And with margin loans, you can end up getting margin calls and have your shares sold out from under you, and you end up being forced to sell your shares at a time that you weren't expecting, which is never a good thing. Non-attendees says Australian dual citizens allowed to open company accounts in low income tax regimes such as British Virgin Islands. Look, I'm not an expert in offshore tax, but I think the answer to that is yes, but there are some tax implications as to the reporting that sits around that as well. I would say that I don't know for the average Aussie, or even for the average sort of reasonably high earning tech worker, if that's something that where the juice is actually worth the squeeze. But if you've got a significant amount of cash to work with, then potentially it could be. And in that case, you probably want to get some good advice to make sure that you're doing the right thing. Do you reinvest? Do you recommend reinvesting dividends? Look, it depends on your strategy, but reinvesting your dividends is a great way to compound your returns over time. So I'm a big fan of it. I do it a lot for myself personally, although we have a lot of clients. Well, we have a number of clients that use the dividends for spending or for other parts of their financial plan. Nigel says, is the principal and interest components of the mortgage repayment, or is the interest component only that you can deduct as an expense? That's a really good question, Nigel. The interest expense is a deduction. The principal repayment is not considered a deduction because that's just you paying down your debt, but you can consider it saving. So it is a cash flow. There is an impact on your cash flow, but it's not actually an expense because it's just you paying down debt, which is essentially like you saving money. Good question, Nigel. Nicole says, what is your opinion on negative gearing versus positive gearing on property? Nicole, I'm glad you asked that because I often make a point of it when I talk about the property stuff that people think, oh, I should buy should I buy a property as positively geared or negatively geared? Now, the reality is that you don't really get to choose. The way that you can control if a property is positively geared or negatively geared is two ways. One is property selection, so the type of property, and I'll come back to that in a second. The second is how much of a deposit you put in. So if you're looking at a property in like say close to the CBD in those higher growth type suburbs where our philosophy suggests that people buy as close to the city as possible but not in the city, then try and get as much land as possible, it's unlikely you're going to get much variance in terms of the rental yield percentages or the rent versus the cost of the property. Not a lot. So if you're going to buy $1 million property in Sydney, say, that I know that the gross rental yield, so the total headline rent, is probably going to be about $40,000 a year, or 40%. The ongoing property expense is going to be about 1%, so all your strata and that sort of stuff. So the net rental income that you receive is about 3% of that property value. Now the rent, so the interest expense that you've got, say on the current rules, is about 3%. So if you borrow the whole amount of the property, you've got a 3% net rental income and a 3% interest cost. So your property is going to be about neutrally geared. If you chose to put in a $500,000 deposit and you've only borrowed $500,000, then the total interest expense is still going to be 3%, but 3% on $500,000. So you're going to be positively geared. So that's really the choice. I hope that makes sense, but that's really the choice that you're facing. It's if you put more deposit in, you're going to end up with a more positively geared property. If you put less of a deposit in, you're going to end up with a more negatively geared property. And we're obviously in ultra low interest rates at the moment. So the example is a bit of a weird one in that the interest rates are only 3%, but when you go to 5%, you see that it's going to be more. So you don't actually get a choice. Now, the exception to that is the asset selection thing, which I mentioned. And this is something that if you buy, say, a property in regional areas, they tend to have a higher rental income return relative to the property value, but then they have lower growth. So you can choose to buy positively geared properties if you go into, the bush, basically, because not many people want to rent there. Not many people want to buy there. There's not a lot of rental properties there, so you generally get a bit more yield, plus the growth is lower. So asset selection and how much you put in as a deposit. I hope you found that helpful, Nicole. Anonymous says, is sole trader ABN tax the same as personal marginal tax rate? Yes, it is. Lauren asked a question about deductions. I'll come back to that, Lauren, because I've got some tips in a sec. Health insurance, I'll come back to that one as well. Individual tax if using Forex platform to invest. Look, you do need to report, that's from Pawan, you do need to report all of your income sources from investing on your tax return. That's part of that declaration. Den says, if you don't have employment income but have gained income via share profits, can you contribute the profits towards super and reduce the marginal tax rate? Yes, Den, you can. You can make those deductible contributions to super, but if your income is below that 18,200, then you're not going to be paying any tax anyway. So just be aware of where you sit in the marginal tax brackets. I'm gonna push on, and I'll come back to. There's a couple more questions there, which I'll come back to after I get through these tax strategies. So, first one, negative gearing. I spoke about that before. With property, can be a great way to save your tax dollars and buy a property at the same time. Maximizing your tax deductions. Yeah, so maximizing your tax deductions. Keep good records, guys. I think that there was a question. I don't know if that was in the chat or something that I saw, but when should you start doing your tax planning? 1 July is the best time to be doing your tax planning, but not for the year that's just been. It's for the year ahead. You want to be doing your tax planning ahead of time so that you're keeping good records, you know what you can claim, you're understanding your tax position and providing for that, and that you're getting the most bang for buck with your tax income and dollars that are there. A lot of people go, oh, I didn't realize I could claim that at the end of the financial year. And by then it's too late because you haven't kept your records. And you don't want to fudge things with the ATO and end up in a lot of hot water. So understand what you can claim, and then you're going to get better records and better result at the end of the year. Franking credits I spoke about with shares. So understanding franking credits is a key part of being a successful investor. So if you're not across that, do your research, get some advice. It's where the tax is paid on the dividend income that you get. Really, it happens on Australian shares. That's really important. Understanding the difference for offset versus redraw for investment properties. This is a really, really big one. For anyone that's got an investment property or has a property that may become an investment property in the future, I've seen a lot of people cost themselves tons and tons of tax dollars by getting this wrong. There is a difference between paying money off your home loan and then redrawing it in the future to putting the money in an offset account and then taking it out in the future. It's a weird quirk with the tax laws, but it says that when you have, say you've got a $500,000 loan and you put $200,000 in an offset. Say you buy a property for $500,000 with a $500,000 loan, and you live in the property for a period of time. The debt is not tax deductible to you because it's your home. But in the future, you want to upgrade your home, and you get an attachment to this property, so you want to keep it. Plus, it's probably a good property, which is why you bought it in the first place. Now, two scenarios. One is that you save while you're in that property in an offset account. Say you save a couple of $100,000. What that does is you got a $500,000 loan, 200 grand in your offset. While that money's in there, you're only paying interest as if you owe $300,000. But when you move out, you go to buy your dream home, you grab your $200,000, you whack it in as a deposit on the next place, and then your debt on the first place was always $500,000. So that the entire amount once you move out is tax deductible if that property is used for investment purposes. Second scenario is if you have the same property, same $500,000 loan, but you think you're doing the right thing, that you put all of your money in to pay down your mortgage, and then when you move out, you redraw the $200,000 and go and use that to buy your home, which is again not tax deductible on the debt. Your mortgage was reduced to $300,000 for the original property, which is now now an investment property, and therefore that $300,000 is tax deductible. But because the purpose of the redraw of that $200,000 was to not buy an investment, but buy your own home, it means that under the tax rules, that amount, that the interest on that 200 grand is not tax deductible. So that you're talking about thousands of dollars and sometimes tens of thousands of dollars, depending on how much you pay down on your loan, that you're missing out on every single year forever from not having the right debt strategy. So understanding the difference between offset and redraw, you're going to save yourself a lot of tax pain in the future. Private health insurance. I had a question on that from Cynthia. How private health insurance works is that when you earn over a certain amount of money, the government, if you don't have hospital cover, the government start taxing you an extra 1% of your income. It's around sort of that $90,000 mark. And what that means, if you're getting taxed 1% on $90,000, that's $900 a year. It is possible to get hospital insurance for less than $900 a year. And if you earn $200,000, the cost is $2,000 a year. So you're basically getting paid to have health insurance. So understanding that and don't waste the money by not getting paid to have health insurance. Plus you got health insurance, which is sort of good. Understanding the ATO timelines after the end of the tax year. So for the tax year that's just finished on the 30th of June, the last date that you can do your tax return, if you're a good taxpayer and on the books of a registered tax provider like an accountant, is in May of next year. So that means that if you've got a tax bill, you've got a lot of time that you can hold on to that money, keep it in your emergency fund, keep it in your offset account, be a bit careful with investing it because shares are longer term investments, but get that money working for you before it needs to go to the ATO. Makes sense. Sorry, on the flip side of that, if you're getting a tax refund, get that bad boy done, get that cash in your bank account sooner. I mentioned tax planning already in July. Also, the second best time to do your tax planning is in April. That's for the year that's about to finish, so that you've got some time to implement some strategies and get some stuff done before the end of the year. What can you do for deductions? Well, there's a limit on that. You can, before the end of the year, so when you're doing your April tax planning, prepaying some interest expenses. So prepaying interest on your investment property mortgage. If you've got other deductible interest expenses, then paying on that. If you're got things like income replacement insurance, you could look to prepay that. Make sure you keep good records. Financial advice is tax deductible as well. Subtle plug. Getting some good advice, paying for that before the end of the year will maximize your deductions in that financial year as well. Help you make even more money in the next financial year. Mistakes that people make with their tax, not tax planning before they invest. It's really difficult to unwind things, as I mentioned before. So make sure that you've got the tax plan before you start, especially if you're going to be pushing reasonably hard to start getting some serious runs on the board. Have your tax plan in at the start. Don't invest for tax purposes alone. I touched on this before with property. It works for, we saw in the financial crisis, a lot of agribusiness, buying almond plantations and timber mills that people end up burning a whole bunch of cash with doing that. If an investment doesn't work without the tax benefits, it's not a good investment. Not keeping your records is a problem as well. Having advice with an agenda. And this is something when it comes to those tax entities as well, trusts, structures, companies, self-managed super funds as well, that there can sometimes, there's a lot of amazing accountants out there, but there can be some accountants that I've seen in the past that are really gung-ho with setting up entities, but ultimately they're the ones that benefit because they know that you have to keep doing that tax work and paying them to do that work over time. So I've helped a few people unwrap a few of those things. Just go into it with your eyes open and understand the potential motivations, not saying the actual motivations, but the potential motivations for the people that are supporting you, so that they know that, so that you know that you're making the right moves. Set and forget, and this is a broader one, but it works for your tax planning as well as your broader money strategy. There's no such thing as a set and forget strategy these days. Everything is moving so quickly that the world is changing, investment markets are changing, the tax rules are changing, what you want is changing, what's important to you is changing. So you can't have a set and forget money strategy anymore. You need to really be doing, you need to make sure that you're doing the right things for you right now. And it's about really, understanding tax rules, what's changing, what's coming up, and making sure that you're on the front foot so that you can maximize all of the deductions that are available to you there. Going it alone, I think, is a mistake as well. You can see probably from the things that I've covered off today already that there's a ton of opportunities, a ton of money that you can save from getting this stuff right. If you go it alone, you're going to be paralyzed a bit by our psychology. It's really difficult to escape. We're sort of set up for failure there. Not taking advantage of opportunities to save tax, to avoid tax costs, all of those things when you could, and less confidence to be aggressive when needed. If you're getting advice around this stuff in particular, it's like the ATO definition of tax deductible. So make the investment, get yourself right on the front financial foot, and you're going to benefit on that one for years to come. So guys, in terms of how you actually plan with your money, there are some key steps that every person needs to go through. Now, this is the process that we take people through when they plan, but it's the same steps that anybody needs to take if you want to get on the front financial foot and make sure that you've got a rock solid plan in place. focus in the first step here, focus in on what's important to you. What does a great result look like? Where do you not want to be 3 years from now? From there, you want to understand all of the different moving parts that are going to impact your plan. You know, what money's coming in, what money's going out, where's it going? What are the tax opportunities? What's your tax position, liabilities, etc. Then from there, explore some pathways or strategies that can take you from where you are to where you want to be. Buying an investment property, buying your own home, starting a share portfolio, doing it with Australian shares with franked dividends, or an alternative option investment in international, whatever. Understand what they look like and see how they fit with your money wants and then your lifestyle wants as well. Once you decide and you decide on the one that gives you the right balance, break it into an action plan, automate as much as you can, and then execute. And that ongoing action is where it all loops back around and the cycle continues. If you get that right, you're going to have a clear plan, have confidence in it, know that you've explored the options, that you're not leaving any money on the table. And why wouldn't you do that? These are all good things to have. So take the time. Money is one of these things that it's important, but it's never really urgent. So it's easy to let life get in the way, and you end up just missing the opportunities to be getting results, and you're leaving this money on the table. So guys, this is my virtual shake. Make this happen. Now is the time, to capitalize on the motivation, new financial year, get on top of things. To give you a bit of a hand, I'll step you through this model, which shows the different stages that people go through with their money and the things that you can do to progress between the stages. Now, essentially it ranges from really bad to really good. The things that typify the stages are how quickly you're getting ahead with your money, your ability to live the lifestyle that you want and make the personal things that you want, and how you're feeling about what's going on. So the first stage that I see people in is this distress stage. For people in the distress stage, they're making no progress at all or going backwards. They're trapped from a lifestyle point of view because they've got no money to do the personal stuff that they want, and they're stressed out from a peace of mind point of view because they've got no money. It's a stressful time. You can't get out of the distress stage without making a commitment to your money. I mentioned that money is important, but it's not urgent, so it's easy for life to get in the way. That's how you can end up in this position in the first place. It takes an active commitment so that you're prepared to put in the work to make it happen. The next stage that people get into are the stalled stage. For people in the stalled stage, they're making some financial progress, but it's slow and slower than they would ideally like it to be. They're able to make some of the personal or lifestyle choices that they want, but it's often a trade-off. It comes at the sacrifice of getting ahead financially at the rate that they want. And then from a peace of mind point of view, they're not fully stressed out, but they got that niggling thought in the back of their mind that there's something more that they're missing out on. Next stage that we see people in is the comfortable stage. For people in the comfortable stage, that's when you're now starting to build some real financial momentum from an investment and money wealth point of view. You're building confidence from a peace of mind point of view, and you're finding a good balance between your ability to live the lifestyle that you want and make the personal choices that you want. And then the last stage here is the very technically labeled the killing it stage, where for people in the killing it stage, you're making some rapid acceleration now, no limits on the lifestyle choices that you can make, and feeling completely carefree. But it is a progression, guys. There's some steps you need to go through and some things you need to do to go through the stages. The first one that I've got there is making a commitment. Second is that you've got to take action, and you've got to do that on an ongoing basis. I mentioned no set and forget. You've got to do some stuff, and then you've got to keep doing that so that you keep moving yourself forward, next step, next step, next step. That's what starts to build that momentum. And then to get yourself into the best possible position, you've got to squeeze every bit of juice out of your situation, that you got to maximize every opportunity, optimize from a debt perspective, doing the right thing with your tax, etc. And those are the things that, again, it gives you that J-curve build. So, guys, I hope you found that helpful. I'm going to answer some questions in a sec, so feel free to pop those into the Q&A, and I'll get to them, get to as many of those as I can. I'll leave you with this quote from the good man Derek Sivers that says, "More information is not the answer. If information was the quote says, if information was the answer, we'd all be billionaires with perfect abs." And you guys don't need more ideas. What you need to get results is you need to take action. Focused knowledge is the key to that. So I hope today has been helpful to give you get clear on those next steps and what you can do. Guys, this is exactly the stuff that we help people with as well. So if we can help you, I'm happy to have that conversation. I've got a note here, and I'm just going to pop into the chat as well, that I'll put this into the chat box, that if anyone wants to, we do these 10-minute sort of tax powwows and general money Q&A sessions where you basically cover any sort of general Q&A that you got. Sorry, I'm just thinking as I'm trying to punch that into the into the box here. I'll put the proper link to make sure that it works as it should. Perfect. Yeah, general Q&A, talk through the opportunities for you and help you understand your next steps. Guys, if we can't help, we're very happy to point you in the right direction. So feel free to take advantage of that. Only goes for about 10 minutes or so. If we can help, though, obviously we can talk about what that looks like. Otherwise, we can answer your questions and point you in the right direction as well. So happy to do that, have that conversation. Again, for anyone that's interested, that's in the chat there. So I'm just going to answer the questions that I've got here. Tips for low-income earners and their tax returns. What deductions would you make? Well, Lauren, if you've got a low income and you're below that tax-free threshold, there's not really much point worrying about any deductions because you're not paying any tax. So don't sweat it on that front. Beyond that, it's just the general deductions. The ATO's website is quite helpful, so check that out. There are some things that you can claim that they don't ask for evidence of as well if you have incurred them, and sometimes you haven't kept records of those. So cleaning, uniforms, those sorts of things. Home office expenses is a big one with everyone working their COVID bunkers over the last little bit. Hope you find that one helpful. Michael, main deductions, I feel like I answered that one. Nathan says, if I want to make personal super cap contributions, unused portion of the past 5 years, do the ATO adjust each year's balance retrospectively, or will it only adjust current year's return? No, it just all counts. So this is the catch-up contributions that the ATO is now offering, that if your super balance is below $500,000 and you haven't maximized your $25,000 contribution limit in the previous financial years, you can actually top that up. That all counts. It counts as a deduction in the current financial year, is how it works. The ATO's got some great stuff on their website there, Nathan, on that as well. Brendan asks, how do you work out if a financial advisor is a good one or a bad one? What questions should you ask? Well, firstly, you should look at how strong their bid game is, Brendan. I think that's probably the most important. But beyond that, questions, look, I think that the charging model is an important one. So do you work on a fee-for-service basis, like just charge a fixed fee, or do you get commissions from placing products? Do you charge an asset-based fee where you get paid more the more that's getting invested? Are there referral payments from, say, like a property buyer's agent? They might clip the ticket if they refer you to other professionals as well. For me, that can be a bit of a red flag. There's no one right or wrong approach. We work on a fully fee-for-service basis. Not everybody does, and there's some great advisors that don't work under that model, but it does give you some things that you should be thinking about to ask some questions to understand the motivations and potential conflicts of interest there as well. So that's one. Brendan, you can also look on their financial advisor register, see if they've got any bad marks on their name. Make sure they're a registered financial advisor on the ASIC authorized register status. Do a bit of social stalking, see what their reviews are like, website. But then a big one is making sure that your advisor works with people like you so that you know that they're going to be aware of the issues that are important to you and the main considerations for the things that you are going to be considering. I'm just going to answer one more question. And it says, I'm seeing a huge bill owing to shares vesting, have new shares vesting. Does it make sense to sell the newly vested shares, or should I wrap this in a huge bill? Does the ATO frown onto me holding onto that until my next year? Look, check out, we actually just did an event yesterday on employee share plans. There's a whole bunch of complexity there. Any one of those answers can be right or wrong, but if you work for a tech company and you've got significant vests around that, get some good help because it's going to pay for itself many times over. There's a ton of ways that you can go wrong if you don't get that one right. So yeah, sorry that there's no one right answer to that, but definitely a bunch of opportunity there. Guys, there are a bunch more questions there, which unfortunately I just don't have time for, but I am going to shoot a note around with the slides and the recording off the back of today. If you have any specific questions, feel free to reply to that or hook us up for one of those calls and we can thrash it out on the call. Guys, I hope you found that really helpful. It's been fun talking tax, and hope to get you on the front foot with this stuff. And yeah, check out, we've got 5 more events coming up with General Assembly, so we'll send that link around as well. Tell your mates, register for those, and hope to see you guys again soon.
Thanks so much, Ben. That was such a great presentation, and thank you for everyone that joined us this afternoon. I'd just also like to remind everyone to